This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through now and look at vertical complex groups and bring in the statement of financial position, because there's some extra complications that we add in with regards to the calculation of goodwill and the calculation of the non-controlling interest. They're two very small bits, but could be important within an exam question. So the overall consolidation process is the same. You have a parent, a subsidiary, and a sub-subsidiary, and you consolidate the assets, the liabilities in full. Okay, so like we've done before, 100% of P plus 100% of S plus 100% now of SS. The issue that you've got is, first of all, with regards to the goodwill. Now, don't worry, the goodwill in the subsidiary remains exactly the same as what it has always been calculated as. So you can see it there. The sub, I'll just write there, that's okay. Nothing different. You take the fair value of the consideration, you add on the non-controlling interest at acquisition and deduct the net assets in working number 2. Okay, so pretty standard fair, and the non-controlling interest will either be on the proportionate share of net assets or the fair value method. It's the sub that you just need to be a little bit careful upon, and it's nothing horrendous that you need to think about, but the adjustment that we see is there on the fair value of the consideration. So essentially what you've paid. Because if you've got a parent, a sub, and a sub-sub, you're trying to work out the goodwill in the sub-subsidiary, aren't we? So it's the sub that will have the investment. The investment is in S's books because they paid to gain control of SS. The issue arises is that we're reporting to the parent shareholders, aren't we? So you've got the parent, the sub, and then the sub-sub. Now, the investment that sits in here, how much of that belongs to the parent? Well, we take the parent share. And that's all that we're going to go through and do. In the sub-sub's goodwill calculation, whatever the investment is that sits in the subsidiary in relation to the sub-sub, we just take the parent share here. So if the parent, like in our previous examples, had owned 80% of the sub, you would put in 80% of the investment. That's it. That's the only adjustment there. You still deduct the net assets from working 2. You still add on the non-controlling interest. Again, just be aware there that if we're looking at the non-controlling interest, it will be either on the fair value or the proportionate share of net assets. And if it was based on the proportionate share of net assets, then that will be based upon the effective NCI. The one that you've got there at the bottom is the non-controlling interest. The good thing here is that the calculation in the sub-sub is okay. There's no adjustments to make there. The only thing I would be aware of is remember that it's based upon the effective NCI, still taking the NCI acquisition, the NCI share of the post-acquisition movement, and that incorporates using the effective NCI. So there's nothing difficult there. The NCI in the sub is the hardest bit, I think, and it will take you a bit of time to think it through. Okay. What you've got there is we need to work out the non-controlling interest in the subsidiary. So parent, sub, sub-subsidiary. So we want the non-controlling interest in here, don't we? Okay. We only want it as the NCI in the sub. We want nothing to do with the sub-sub, do we? So we just want to look purely at the NCI in the subsidiary. Now there's just an issue, isn't there? Because what sits in the sub is the investment in the sub-sub. So what we need to do is to calculate the NCI in the subsidiary. We need to remove anything to do with the sub-subsidiary. So what we're going to go through and do there is we're going to remove the non-controlling interest share. So if the parent owns 80% of the sub, we're going to eliminate 20% of the investment that S has in SS. Okay, so we are removing that from the non-controlling interest in the sub because we want the pure sub only. We don't want anything to do with the sub-subsidiary. That's hard. That's really tough to get your head around. Think through it again. So what we've got is the sub and the sub-sub. We're looking at the NCI in the sub only. So we need to remove anything to do with our sub-sub sat down here, don't we? And the only thing that we have in the sub in relation to the sub-sub is the investment. So we're going to remove the non-controlling interest share of that investment in the subsidiary. Okay. At the end of the day, learn the pro forma, learn what numbers go into it, and you shouldn't go too far wrong. But that's really, really, really tricky because one, you have to get it in the correct column, and two, you need to make sure that you put it in brackets because we are removing it from the subs NCI calculation. So we're going to go through and look at an example that brings together the group statement of financial position along with a vertical complex group structure. Again, it's not something that you're likely to see within the exam, but it helps you understand the big picture so that you can then start to practice the questions that will tend to ask you to calculate the goodwill within the subsidiary and sub-subsidiary and the non-controlling interest within the sub and the sub-subsidiary. Okay, so it's important to get that bigger picture first. So what you've got is, if we go through and have a look at the question, quite a lot going on within it, but pretty standard in that it wants your position statement. It's for the Bravo group, so Bravo must be the parent. And we're there at the 31st of December. Is it 2015 or 20x5, should we say? You've got the three sets of financial statements. Is it there for Bravo, Gale, and Russell? Knowing that Bravo is the parent, isn't it? So what have we got? Well, it tells us that on the 1st of January X5, so that's the start of the year, Bravo purchased, is it 80% of the equity share capital of Gale? Okay. Whereby in the second part, on the 1st of July X5, so part way through the accounting year, we acquired, was it 70% of Russell? Okay. So if we're going through and drawing up our group structure, we've got there, is it Bravo is the parent. Bravo bought, was it 80% of Gale? And I think it went through there and said that Gale purchased 70% of the equity share capital of Russell, didn't it? Okay, so if that's the case, we can work out the percentage ownerships. Non-controlling interest there is 20%, isn't it? And then what we have here, if we look at the effective control, is that 56%, so 80% multiplied by 70 is 56. And then is it your effective non-controlling interest is there at 44%, isn't it? Why have we done that? Well, we know that Bravo is the parent, it has control over Gale, so that is therefore the sub. Gale has control over Russell, which is therefore the sub-sub, isn't it? Okay, excellent. So that's our group structure. What we need to go through and then do, don't worry so much about the basics in terms of the consolidation and adding across 100% line by line. What we've got there is we can work out, is it the net assets? So your standard working two, and we're going to go through there and do two net assets workings. Is it one for Gale? And then we'll do another one in a moment. Is it there for Russell? Again, when we're looking at our net assets working, we look at what happens at the year end. We look at what happens at acquisition. And then we look at what happens post acquisition. Now, within this question, the acquisition date of that first subsidiary was the 1st of January 20x5, wasn't it? So might be worthwhile just sticking it above there as a bit of a note. We have share capital. we have reserves, don't we? The year-end figures are usually straightforward. We just get them from the statement of financial position, isn't it? So if we go through there and look at, is it Gale's SFP? You can see there that we have 50,000 and is it 75,000. So I can put in the 50. I can put in the 75. Don't forget, whatever figure you have at year end for the share capital will be the same at the acquisition date, isn't it? And what we need are the retained earnings at the 1st of the 1st, X5. So the information goes through in part 1 and tells us the fair value of identifiable net assets acquired was 90, and the fair value of the non-controlling interest was 25. The fair value of the net asset at acquisition was not materially different to their book value. So what we're saying there is that if there's no material difference to their book value, then that 90 million is the fair value of the net assets. So instead of telling us that the retained earnings were 40, it's asking us to work that out, isn't it? Okay, if the share capital was 40, if the net assets are worth 90, the reserves need to be, is it 40? 50 and 75 is that 125,000, and our post acquisition profits are there, is it as 35,000. Okay, everybody happy with what we have done there? Yep. Again, you know, Gale is the sub, so we're not doing anything different to what we have previously done, are we? Okay. If that's Gale, we then need to do exactly the same with regards to Russell. So again, we go with the figure at the year end. We go with the figure at acquisition, and then post acquisition. Same layout, share capital and reserves, and the year end figures come from the sub statement of financial position, don't they? So back to the question, 40 and 45, isn't it? So we've got there, is it 40 and 45,000. Okay, again, that 40 at year end for the share capital will have been the 40,000 that you have at acquisition, so that will never have moved. And we also need to work out the retained earnings. Again, similar situation. It tells us the fair value. Here it actually tells us that the retained earnings, doesn't it, back to the normal way. We're there as 20 million, so a little bit easier in this one. It also says that the net assets were the same as the fair value. There was no difference. So we have, is it 60,000 at acquisition, and we have, is it there 85,000 at year end. If you're curious in terms of the acquisition date, that there is no issue here because the sub and the sub combine at a later date than when we acquired the subsidiary. So we acquired the sub on the 1st of Jan. So we had parent sub at the 1st of Jan. And then 6 months later, 1st of June, the subsidiary joined the group. So the acquisition date there is that 1st, I think maybe July, was it? 20x5. So we were given the retained earnings at that date, and therefore we will go through and use them. Okay. Does that go through there, I think, and give me post-acquisition movement in net assets of $25,000. Excellent. We then move into, do we want to call it working number 3 or your third working, which looks at goodwill. And what I'd do here, like you see within the notes, I would just go through that in the middle of your page, put in the cost, NCI, and net assets. And we have it there. Is it for Gale, the sub? And is it Russell, the sub? Well, when we're looking at the sub, that should be pretty straightforward. There's nothing new that we have got to cover there. So what you've got is we're looking at the amount that we paid. Is that there, the 74 million? The non-controlling interest at fair value is 25. And we know what the net assets are already. They are there at 90 million, aren't they? So a nice easy calculation there. So 74,000 as the investment, 25,000 as the NCI, and was it 90,000 there for the net assets? If you total that up, I think that gives you 9,000, isn't it? Okay, excellent. The subsidiary is where you just need to pay special attention, isn't it? Because there's that slight little adjustment that we'll need to make in a moment. It says we bought it for 55 million. The non-controlling interest is at 20, and we know what the net assets are from our working. So the non-controlling interest I think we had there was 20. The net asset to acquisition for Russell, there is it as the 60. So we can put in that 60,000 there. And we know that the investment was 55 million. That's how much that we paid. But be very, 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 very careful, isn't it? If we go back to our group structure, you have the investment that sat there, isn't it, in Gale's books. Gale paid 55 million to acquire Russell. Of that 55 million, the parent, Bravo, owns 80%. So here we're going to have to put in 80% of that 55,000, which I think comes to, is it 44,000? If you total that up, does that go through there and give you 4,000? And you can combine those two together, can't we, on the group SFP to give you goodwill in total is that of 13,000. Okay, so after all of that, the only real issue that you have is that number there, isn't it? Just be careful. We need to take, isn't it, P share of the investment that is held within S's books. Excellent. So moving on, that's your goodwill done. Let's go through there and have a look at the non-controlling interest, your NCI. So again, standard working for, you take the non-controlling interest at the date of acquisition and you add on the non-controlling interest share of the post-acquisition. Just leave it at there for now. There is something extra we'll need to do, but let's keep it simple. So we have there, is it Gale? And we have, is it Russell? Now, what I would recommend is that you put the NCI percentages above each sub and subsidiary, respectively. There's a 20% NCI in Gale, 44% NCI in Russell. Okay. The non-controlling interest at acquisition of Gale was that 25 million, so 25,000, and for Russell it's 20. Okay. The non-controlling interest percentage, that's why I think it's important that you put the percentages at the top of each column, because then for Gale, you know that you're taking 20% of Gale's post-acquisition profits, and Gale's post-acquisition profits are 35. is that there? I think it gives us, oh, wrong colour, 7,000. For Russell, we take 44%, don't we? 44% of what? Well, Russell's post-acquisition profits. So 44% of, is it the 25,000? Does that give me 11,000? Okay. However, there is just one little bit that we need to put in. We also need to deduct, don't we, the non-controlling interest percentage of the cost that you have in S's books. So what you have there is, we know the NCI is 20. The cost of the investment, I think that S had, was 55,000, wasn't it? Okay. Remember, we're just looking at the sub only. Now, if we go through and look at the sub only, now here is the subsidiary, isn't it? So you have there in Gale. Gale is the sub, isn't it? There is an investment there of 55,000, which forms part of the non-controlling interest, forms part of the net assets, doesn't it, of that subsidiary. We don't want anything to do with the subsidiary within the non-controlling interest calculation of the sub, do we? So we need to remove the non-controlling interest share of that 55,000. I think that there gives me 11,000. When you total everything up, I think you have 31. And is it 21,000? Okay. So again, I think that bit there is very, 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 very hard. There's all sorts of mistakes that you can make. You can put the right number in, and you put the right number in the correct column, but forget to deduct it. Okay, so be careful. You could put the right number in, deduct it, but put it in the wrong column. It doesn't go into the subs column, it goes into S's column. So do just be very, very careful. There's plenty of mistakes that we can see that could arise there. Again, when we prepare the full consolidation, we just add the two together, don't we? 52,000 is the NCI. Final working before we go through and perform the full consolidation is to look at the group retained earnings. So is that there 100% of the parent retained earnings? So the parent's retained earnings are there at 65,000, aren't they? So we put in 100% of P at 65. We add on 80% of Gale's post-acquisition, which is 80% of 35. I think that gives me 28,000. And then we add on the parent share, 56% of Russell's at 25,000, which gives me 14. If you total that up, that gives you the 107,000 as your group retained earnings. There we go. We've done the group structure, the net assets. We've gone through as well and looked at the goodwill, the non-controlling interest, and the group retained earnings. Those 5 separate standardized workings. There hasn't been any pub adjustments, no intercompany balances, no impairments or anything like that. Let's just make sure that we understand the basics. And the basics are that everything is the same, isn't it, as what we've previously done with regards to the consolidation. However, there are 2 things you need to concern yourself with. One is the NCI adjustment in the subs column. And then when you're working out the goodwill, you need to make sure there that in the subs column, you put in the parent share of the cost of the investment, because that is what the parent effectively owns, isn't it? Owns 80% of it. Having gone through and done all that, you can stop the video if you want and just look at the model answer, but let's just go through, finish it off, and look there at the group SFP. So we have there, is it property, plant and equipment, 90, 53 and 70. We also have, is it the Goodwill? The Goodwill figure we went through there, 9 and 4. So that there is 13,000. We've got our current assets, is it there, of 40, 48 and 33. $40,000 plus 48,000 plus 33,000. Okay, and then we can total all of that up. I got my calculator. So what we got, 90 plus 53 plus 70 gives me 213,000. 40 plus 48 plus 33 gives me 121,000. Gives me 347,000 on my group SFP for the assets at the top. If I then go through and look at my equity and liability, so we have the equity share capital, don't we? That's of the parent only, which is there as 100,000. I have my reserves from my group retained earnings, which was 107,000. My non-controlling interest was that 52,000 when I added them all together. And then to pull together all the pieces of the jigsaw, you've got non-current liabilities at 20, 15 and 4. So NCL 20,000 plus 15,000 plus 4,000, 39,000, isn't it? And then you have your current liabilities, 19, 16, 14. 19,000 plus 16,000 plus 14. 16 and 14 is 30, plus 19 is that 49,000. Gives me there is that 3, 4, 7,000, which is a bonus, isn't it? You've got 3, 4, 7,000 as your assets at the top, and your equity plus liabilities is the same, 347,000. There we go. So big comprehensive example, but as I said, I think the key focus there is, can you do the goodwill calculation and can you do the non-controlling interest calculation? If you can, you're well on the way to success.